So let's move on. We're going to start talking about the next section of that Schedule A here, the state and local taxes. All right, so what kinds of taxes, first of all, would be included in these? Now remember, these are taxes paid, not like refunds received, but taxes that you paid. 4 major categories of taxes that are paid that would be included in here: personal property taxes, local real estate property taxes. Okay, so we've got a difference here between personal property taxes and real estate property taxes. Personal property is essentially anything that isn't real estate. So a vehicle, a boat, an airplane, hopefully someday you have an airplane, things, RV, ATV, those types of things would be personal property. Real estate is some sort of building or home, okay? And not necessarily just real estate that you live in. It could be a home, a property that you own. It could be your vacation home, right? Hopefully you have an airplane and a vacation home someday. Maybe you have one now. I have no idea. So other state and local taxes, I certainly don't. Other state and local taxes would be like income taxes. So like state of Iowa has income taxes. Now, not every state has income taxes. There are certain states out there that they have no income tax. Nevada, Alaska, South Dakota, I think New Hampshire, Florida, Texas. Oh, I think there were 7 or 9. I can't remember what the other ones are. Washington doesn't have any income taxes. Trying to think. If any of you out there know, chime in. Tennessee, okay, it's Tennessee. I think there's one more that doesn't have any income taxes. Anyway, so there are states out there that don't have any income taxes, but most states do have an income tax. So any taxes that are paid to the state or local authorities would be included in those other state and local taxes. Now, there is a choice. If you happen to live in a state that doesn't have an income tax and you want to deduct taxes, you do have a choice that you could deduct sales taxes. Now it's kind of complicated to calculate how much you spent in sales taxes unless you like saving up all of your receipts for the year and then totaling them all up at the end of the year. Most people don't like to do that. So the IRS has like a calculator. Yeah, Washington has a calculator online. I'm going to show you what that looks like to figure out what your sales taxes would be. Now this is based on an average, obviously, and any items that you purchased that year, like a car or a boat or something that you paid a lot of sales tax on, you would be able to add that amount to the calculation. But you get to choose whichever is greater. So if you didn't pay any state income taxes, you could choose to claim state sales taxes that were paid. And then also foreign taxes. So if you own maybe property in a foreign country or you have income in a foreign country that gets taxed by that foreign country, you could claim the foreign taxes as a deduction. Personal property taxes, we're going to start talking about that. So first off, it has to be levied on personal property. Obviously, it wouldn't be a personal property tax if it wasn't. It has to be what they call an ad valorem tax, which means it has to be based on the value of the item, not on some other factor. Like sometimes cars, the tax on them is based on their weight. If it's based on weight, it's not an ad valorem tax, and it would not be a deductible local tax or personal property tax. And it has to be imposed on an annual basis. Now, that doesn't mean that you have to pay it on an annual basis. I had clients when I was living in Arizona, I had clients that would pay their vehicle taxes 2 years at a time. It was assessed every year, and that's what it needed to be, but they paid it every 2 years, but that meant it was still deductible to them, even though they paid it. So so it has to meet those 3 tests in order to be deductible. Now, we get into a little bit of a sticky situation when we have property that's owned by more than one person, and they're on different tax returns. So, for example, if you own a car is not really a very good example, but if you own, we'll talk about real estate for a moment. If you own a piece of property with, say, your brother, if you live in a state that has what's called joint and several liability, that's joint and several, not severable, but joint and several liability. Joint several liability means that both parties are responsible for the entire amount. So if one party, if you own this property with your brother 50-50, and it happens to be located in a state that has joint and several liability, that means that if your brother doesn't pay his half, you still have to pay the whole amount. You're responsible for 100% of it if your brother doesn't pay his amount. In states that don't have joint and several liability, then it would be 50-50. So you'd only be responsible for paying your half of the property tax. The state would go after your brother separately. But if it's a state that has joint and several liability, then the taxes, so you have to, in order to deduct the taxes, you have to own the property and you have to pay the tax. So, and I guess there's an example here. We'll read through this example because it shows it. We got 2 brothers, again, Jacob and Rami. They own a parcel of real estate with ownership interests 30% to Jacob, 70% to Rami. Jacob pays the entire $2,300 of real estate tax. So Jacob, even though he only owns 30%, he's paying all of it. If they live in a state where all owners are jointly and severally liable, so that joint and several liability, then Jacob would be able to deduct the entire $2,300. So if you've got joint and several liability, you get to deduct what you paid, everything that you paid. If there isn't joint and several liability, you can only deduct the amount you're actually responsible for. So the second part of the example, same facts, but Jacob and Rami live in a state that does not have joint and several liability. So in this case, even though Jacob paid $2,300, he is limited to a deduction of $690, which is 30% of the total tax, even though he paid the entire amount. Okay. Property taxes on property sold during the year. So remember I said you have to own the property and you have to pay the tax. Well, sometimes when, well, actually all the time, when you buy or sell real estate, there's a timing difference between when taxes are due and what period they're actually for. Like right now, at the end of, actually, property taxes are due in 2 days. But you're not paying for 2022 taxes, property taxes, on September 30th. You're paying for property taxes from 2021. So if that is the case, you may not have owned the property in 2021. So even though you're paying the tax on September 30th, if you didn't own the property for the period in which the tax is being assessed, then you don't get the deduction for it. Now, usually, what happens is all of that is figured in at when you close on a property. The seller will give you some credit, so because they know, oh, you're going to have to pay those property taxes at a time, and it covered the period that I owned the property, so I'm going to give you some money to help you pay those taxes. But there's some calculations that have to be done, and that's what this example is going through here. Okay, again, I'm not gonna read through this. You guys can read, and I want you to read the chapter. So, all right. So personal property taxes, we kind of interlaced that with real estate taxes a little bit in a couple of our examples. But real estate taxes would be included in this. So those property taxes, like the ones that are due in a couple of days. Now, sometimes when individuals, if you have a mortgage, so if you're paying a mortgage, oftentimes, not just sometimes, but probably most times, those property taxes are paid through the mortgage. So the mortgage company will collect money every month from the property owner. And then when it comes time to pay the taxes, the mortgage company actually pays the taxes. But there's usually a difference between the amount that's collected and the amount that's actually paid by the mortgage company. The amount that's paid by the mortgage company is the amount that's deductible, not the amount that's paid through the mortgage payments by the taxpayer, but the amount that the mortgage company actually pays. So here's an example of that. We've got Miriam. So Miriam has a monthly mortgage payment of $1,500. $1,250 of that is for the mortgage principal and interest. So for the actual house, $250 of it is for the real estate taxes that have to be paid every year. Every month, the mortgage company deposits that $250 into an escrow account. From that escrow account, they pay the property taxes when they come due. Well, when they actually came due, the amount was $2,800. So they had collected $3,000 from Miriam, but they only had to pay $2,800. The amount that Miriam gets to deduct is $2,800, because that $200 is not going to pay, that extra $200 that was collected is not going to pay property taxes. It's probably going to stay in the escrow account and then reduce the amount that she has to pay next year every month toward these escrow payments. So that would be included. So those real estate taxes are also included in this. So let me show you. So state and local income taxes. So income taxes that you paid during the year, and I think we talk about, yes, we talk about that in a moment. They don't really go in order on this subject. So state and local personal property taxes would go on line 5C. So that would be for things like automobile registration, annual registration, boats, motorcycles, that kind of stuff. State and local real estate taxes would go on line 5B. Line 5A is going to be state and local income taxes or general sales taxes. So let's talk a little bit about that. So state and local taxes are, for the most part, it's usually those income taxes that you pay, but these are taxes to the state. So for example, the amount of withholding that you have from your paycheck that Iowa takes, your Iowa withholding, that would be a payment, a state tax, income tax payment. That would be included in this category of state and local taxes. If you made estimated payments to the state, those estimated payments would be a state income tax that's being paid and would therefore be deductible. If last year on your taxes, or actually this year, this past April, you had to pay the state of Iowa, you did your taxes and it turns out you owed them money and you had to pay the state of Iowa an amount, the amount that you paid them would be considered income tax and would be deductible as a state and local tax. So these are amounts that you pay to the state, or if there are local taxes as well, that would also be included. We don't really have local taxes here in Iowa, but there are some places that do. Michigan, Ohio, a lot of those states in the East Coast as well have, like New York, those places have oftentimes have local taxes. So those would also be included in those state and local taxes. So all of that would be added as well to the total for state and local taxes paid. So here we've got an example. So 2020, Ricardo had $4,700 in state income tax withheld from his paycheck. When he filed his 2020 federal tax return in April of 2021, he was eligible to itemize and deducted the $4,700 in state income taxes paid. So it reduced his 2020 income and his federal tax liability. When he filed his 2020 state tax return, he found that he had overpaid his state taxes, was due a refund of $800. So he received the $800 state refund. Now think back to when we were doing the calculation of refunds that were taxable. Remember, in order for that refund to be taxable, state refunds to be taxable, you have to have itemized in the year before. So that's what we're talking about here, but we're talking about the beginning of that calculation, when you actually are claiming those taxes as an itemized deduction. In this case, the $800 in refund must be included in the federal taxable income because he received a tax benefit for the $4,700. He deducted the $4,700 one year, but then he got $800 of it back. So just like with that medical reimbursement, the timing difference of the medical reimbursement, we have the same thing with state taxes. If you get a refund and you itemized, then you've got to use that calculation that we did in chapter 3 for figuring out how much of that refund would be taxable. But if you don't itemize, then you don't have to do any of that. You don't have to claim that as a refund. I'm sorry, as income. Let's see. Oh, I mentioned that for those states that don't have income tax, that there is another option for individuals. They can claim sales taxes. Well, it's really difficult to add up all of your receipts, right, for the year and figure out. You could do that. You could figure out how much in total you paid in sales tax, or you could use this calculator to estimate. So what you do is you go, there's a link here in your book right there, and enter the tax year. Okay, so let's say 2021. What was your filing status? We'll say married, filing jointly. How many dependents? Let's say we got 2 kids. Did you purchase any or long-term lease for any of these items? Nope. All right. So enter you and your spouse's adjusted gross income. Let's just say it was $72,000. Did you have any of these items? Nope, we're not going to do that. So it's just $72,000. Enter where you live. Did you live at the same address all year? Yep. Zip code. Okay, let's say we lived in Des Moines, Beaverdale. Not really a city, but okay. Your total sales tax deduction is $1,034.83. So it does the calculation for you. It's an estimate, obviously. So you can deduct if you itemize deductions on your income tax return and your state and local governments collect income taxes, you can decide whether to deduct $1,035 for sales tax, or claim so you could claim the sales tax deduction, or you can claim your income taxes paid. For most people, they will have paid more in income taxes than in sales taxes, but you do get a choice between the two. Okay. Foreign taxes as well are included here. So let's go back. So again, state and local taxes, that will go on line 5A. Remember, so you may include either income taxes or sales taxes, but not both. If you elect to include sales taxes instead of income taxes, check this box. If you choose just income taxes, though, don't check that box. Okay. And then we would have, let's see, foreign taxes would go under other taxes. So if you paid taxes to a foreign country, maybe you had investments there, maybe you had property there, any type of foreign taxes, you actually get a choice between taking a credit for the foreign taxes paid or taking a deduction. For most people, the credit is going to be more beneficial. But you can take a deduction for the foreign taxes paid. So that would be included then on, sorry, right here, you would list the type. So you just say foreign income taxes and the amount. $700. All right, so how would this look? Also, so I forgot to mention, this is really important. All of these taxes here above line, well, included in lines 5A through E, all of these are limited to $10,000. So you cannot claim more than $10,000 total. So let's just say we had state and local income taxes that we paid of $6,000. We had real estate taxes of $5,000. Personal property taxes, $500. We're going to add all of that together. That's $11,500. Enter the smaller of line 5D or $10,000. $5,000 if married filing separately. So if you're single, you still get $10,000. If you're married, you get $10,000. Another marriage penalty. $10,000. Now we had some foreign income taxes, so we can make that $10,700 there. Only those foreign income taxes aren't included in that $10,000 limitation. But all of these taxes are included in the $10,000 limitation. Okay? Questions about state and local taxes. So this is just an example of the types of documents. By the way, you can look up property taxes, and I would use this all the time. Deacon Schneider. Now, Polk County doesn't do this. They've got their own search mechanism, but you can go all these states. So Iowa, let's say Ames, and we'll just say Aspen, I don't know, 3110. That's not my address, but I just happen to know that there's an Aspen Drive. So you can look up, so here's 3010 Aspen Drive. Here's all the information on it. You can even see how much they paid for it. So they bought it in 2020 for $321,000. Here's the taxes that they paid. So you can see the time, kind of the timing difference here. So if we needed to see how much they paid in 2021, so look, this is for tax year 2019. They don't pay that until September 2020 and March 2021. So right now, September 2022, we're paying the first half of 2021's taxes. So that's why I'm saying that there's a timing difference here. So in 2021, they paid in March 2620 and in September 2660. So in total, they paid $5,280. So that's the amount they would be able to put here in this line. That would change this number, obviously. But just kind of an FYI, you can look up, you just go to county assessors and you can look up, like Polk County. This is all public records, so. S-O-R. Probably spelled that wrong. Yes, S-S-S-S-S-S-O-R. So the county assessor, Polk County, property search. Let's see. Property search. Oh, you can look up residential sales as well. Let's see. Simple search. You can look up by owner, parcel number, street address. Let's see. This is a house that I lived in when I was a child. Let's look it up, shall we? Yep, look at that. A little Beaverdale brick. I remember that house. So this is all the information for Polk County. So this one was sold 2020 as well for $190,000. I think you can look up. See, this one's not as friendly It's not as user-friendly as the other one is, because you've got to actually search for how much was paid in taxes. I think it's, oh, we can look at the tax statement. Here we go. I think it's on here. Payment history. You gotta click in there a lot. No records found. Oh, well, that's interesting. Payment history. Anyway, so there you go. You can go and figure out how much your neighbors spent on their house. You can go and look it up. Questions on the state and local taxes. That's the second category. No? Okay. I'm going to pause this.